All right, if you look back to 1977, Star Wars: A New Hope comes out in cinemas, and you have young Princess Leia inserting a little video that she made into a little droid robot R2-D2 with the message to Obi-Wan Kenobi, a Jedi, former Jedi Master General in the Clone Wars, asking for his help, that he is their only hope. The Bank of England is the new Obi-Wan Kenobi. The Bank of England came through. They were the only hope for a very oversold market. They came through last night or this morning, and markets really rallied. Markets latched on to this whatever morsel of potentially positive news it could grab, and it did, and we rallied. Okay, so does that mean the low is in and Tom Lee rallied to the end of the year? So we're going to break that down, what the expectations are going forward, whether it's a bull market or a bear market. We'll break that. I'll show you what I expect and why, and past precedent for why, and then we'll take a look at what's driving the price action. Big move in the dollar, big move in bonds. We'll break that down and talk about what it means, especially with some of the parabolic moves it's made lately. The bigger movers in the sector rotation, which is there's a big outlier there. We'll talk about what that means, and then our trade idea, very similar trades to others we've been doing lately. So let's go ahead and get started. Today is Wednesday, September the 28th, 2022. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get started, I invite you to subscribe to our YouTube channel with this icon here in the bottom right corner of your screen. Hit the thumbs up icon down there to like our video, comment on anything that stood out to you. Join our website on MarketScholars.com with that link popping out in the top right corner of your screen. Follow me on Twitter for more content between the videos from day to day, and join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, check out some of these things over here, these classes and videos on the right. Come down to the bottom, click that heart. It opens up this tab, hit that like button, click this thumbs up icon, it opens up that tab, click that like button. Again, we almost got to 100 on the last video. Getting to 100 is a really, really big deal. That's why we always ask. That's why both Brandon and I both ask on every video. It really helps us get our content out to all of our followers. So if you can do that, we'd really appreciate it. And appreciate those who do that on a video by video basis there. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. So we had 5 clusters in a row. Again, only the second time in 40 years that we've had that, and I've only had the time to go back 40 years. So who knows how many times before that we've had one. It's very rare. It was 2018 was the last one that we had, and that was a policy error that the Fed actually came out and admitted almost immediately after that, and started to be a little bit more accommodative after that last rate hike, at the same time that we were getting some trade issues with China. So that was the last time we had 6 in a row, and we had 5 here. And of course, we're oversold. We're going to bounce. We're bouncing back up. MACD, the momentum, and the near-term line bouncing up. Not surprising. Neither one of them's at extreme bullish levels, but a pretty good move. We did not quite close above yesterday's high point, 37.17. Well, I guess we did. 37.17. We closed a smidgen above yesterday's high point. So you can see we're still 6%, 6.25% below the 30-day moving average. The intermediate line's at least no longer below 5. But remember, it's not 5 that's the unbelievable. I mean, I guess it is rare. It's 10. That's very rare for the intermediate line. In fact, when it is the last time we've been below 10 this long, I mean, again, going out, I mean, you'd have to go even to 2018. Like, if you look at COVID, we weren't below 10 for very long. Like, where did it go? So right here, when COVID, we didn't get below 10 for very long. We went down, bounced up, went down, kind of meandered around it, up and down, but then came up. Didn't stay. 2018, when we had the 6 clusters in a row, we got below 10 for a few days, came right back out of that. The last time that we've been below 10 for this long was in the move that started the bear market in 2008, right? We had the pullback. Let's see if I zoom out a little bit. You had the pullback initially, the failed pullback bounce, the correction that lasted over here, the failed correction bounce, and then the move to and through the 200-week moving average that starts the bear market, and then the return move, right? So during this move was the last time that we stayed below 10 for that long. We had multiple clusters, not in a row, but we just kind of went up and down, up and down, up and down, and stayed down there for quite a while, for weeks, for multiple, almost an entire expiration cycle. We were below 10. So that's a long time, and again, that's, it's kind of similar to what we're seeing right now in terms of how long we've been below 10 here. It hasn't been a full expiration cycle, but pretty much since the beginning of this expiration cycle, we dropped below 10. Ironically, on an up day, we dropped below 10. We got to 9.5, and then have been below 10 every single day since. So, and we're still actually above the 200-week moving average. You'll see here in a second. But you also notice that we're still below. You notice now we have new green Fibonacci since we're on a new intermediate run. We're not using this intermediate run anymore. We're on a new leg lower. We are still below the 23% retracement of this intermediate run, so we haven't started to retrace. As much as we rallied today, we haven't started to retrace yet. This is just noise when you're between 0 and 23. You are still below these really important long-term Fibonacci lines, from the red one being from the 2009 low point, March 2009, the black being the COVID low. So we had broken below. We faked out over here, and now we're broke below again, and so far are holding that breakdown. And then of course you have the 23% retracement of the long-term year-to-date decline, that we don't start to retrace that again, because we were retracing it here. We won't start to retrace that again until we get above 3,900. And that's where you have that 38%. So I think kind of like best case scenario for this near-term rally is we get up towards 3,900. We'll probably most likely around 38.25 plus or minus a few points. But I think your best case scenario is to get to 3,900, where you're going to meet some pretty significant resistance. Obviously your 30-day moving average will probably be around there by the time we got there, as well as other moving averages. So that's kind of what we're seeing right now. Again, all the market forecast charts are pretty much all showing the same pattern, almost exactly the same, which again goes to show what kind of bear market we're in, bearish market we're in. I think we're in the beginning stage of the actual bear market, transitioning from just a correction to a bear market. We're in the initial stages of that, but you can see we're not anywhere done. We're not anywhere close to, ramping up to the upside on this. Even if you're looking at the Hakinashi candle today, this week, right? We still got 2 days left, but it's still a lower close. And as of right now, we're closing at 36.93. We're trading at 37. So as of right now, next week's close has a chance of being more bullish, as being a higher week, kind of like we had here. And then you need to close above that period to be bullish, which we didn't. We came back down and got lower closes. So, we do have a lower close. The PPO is still falling. You got a bearish candle. So you're still bearish here on this chart. The PPO, like the gap between we're still in pink territory, which means we're still in this is a long time. Most of this pink shading, the PPO is actually rising, right? The PPO is rising throughout most of that pink shading. You have to go back quite a bit. Pink shading being when the 10 crosses below the 40, right? You go back to this correction, the PPO spent most of the pink shading rising. You go back to this correction, same thing. PPO spent half or more than half of the pink shading rising. Remember, on this one so far, the pink shading has been falling for most of the time. And again, you'd have to go out to like 2008, where it's been something similar, right? Where it's been most of the time falling in the pink shading and rising at the very end. So that when you have corrections, the PPO will start rising immediately and just keep going, right? That's what happens with corrections. Rising immediately, and just keeps going, right? We set the low point, it rises immediately, it keeps going. Corrections, remember, this is why I'm so adamant about the terminology. Corrections get recovered within months. Pullbacks get recovered within weeks. Corrections get recovered within months. Pullbacks don't get the pink shading, right? Only the corrections do. All these others are pullbacks, right? They get corrected within weeks. Corrections take months to recover. Bear markets take years, like multiple years to recover back to old highs. So again, another sign that this is going to transition into a bear market, not just a correction, is that we set the low point and we didn't just keep going up. We turned back down, and we're spending more time going down during the pink shading than we are going up. And so that's a problem, right? That's a problem for, you know, if this is just going to be a correction. When you look at the some of these other oscillators, let's look at the 3 green arrows really quick. You notice, nice good rally today, we still have 3 red arrows. We're nowhere near close. If we get a nice good rally tomorrow, we might get a green arrow on the MACD, but all pink shading all across the board. We're nowhere near 3 green arrows, which gives you the green shading, which is what you want when you start a new intermediate leg higher. So we're not near that yet. You're still below the 8-day moving average. I mean, we could ramp up 2% and still be quite a bit below the 8-day. I mean, that's going to take a pretty decent move tomorrow to get above the 8-day. We're still way below the 17-day, which is right around where those real significant Fibonacci resistance levels are, the black and red lines. And of course, where, remember, we have to activate this and move this now to our new intermediate leg lower. And we also have to activate this one to move it to the new low too. So, you know, we still have, you know, there's some pretty significant resistance around 380. The 17-day is going to be there. And then, like I said, by the time, if we get up to 390, you're going to your 30-day moving average is going to be at that point. And there's going to be quite the gap between the 30 and the 50. And I got someone asking me yesterday about where do you see the crossover between the 30 and the 50? It's right there. The blue line is the 30. The orange dotted line is the 50. That's pretty obvious. And like I said before, every other time, here and here, every other time you got the bearish crossover, the 30 coming down below the 50, you got to rally. You got to rally there. You got to rally there, right? Immediately, you know, you set the low point on the crossover, and it rallies. It rallied there, it rallied there, and we're probably going to rally right now after this crossover. But you notice, after the rally, it kept going down. After the rally, it kept going down. After the rally, it will more likely keep going down towards 3,200 is kind of where I'm expecting. If we're going to actually be in a, you know, if this is the move to and through the 200-week moving average, then we're probably going to work our way down towards 3,200, 320 on SPY, 3,200. If this is still just a correction, and there's still a very low probability, but there's a chance, then we're probably going to stop at 3,500, and that's it. 350, that's it. And then work our way back up towards that 50-week moving average for the failed correction bounce. I don't think that's the case because I think that was your failed correction bounce. I think we're probably going to work our way towards 3,200, then get a new intermediate run, which will be your return move. Every bear market starts with those 3 intermediate rallies, right? Every bear market here starts with 3 intermediate rallies. The failed pullback bounce, the failed correction bounce, and then the return move. So if I go back like to 2008 for an example, here, let's go back. Let's go all the way back to like 1970 so I can show you that 73, 74 as well. Every bear market starts with 3 intermediate rallies. Isn't that interesting? So here's 2008. Here, if it'll stop moving on me. It's still okay. Now it's done. So here's 2008. Okay, so here's the pullback, failed pullback bounce, right? There's your pullback. There's your failed pullback bounce. So the intermediate line gets above 60. That's your intermediate rally. There's your correction. There's your correction bounce. So the intermediate line gets above 60. There's your second intermediate rally. There's the move to and through the 200-week moving average. There's your return move, which typically happens after you break a major support level, the 200-week moving average. The intermediate line got to 60, and then the bear market started, right? There's your bear market there. You had one intermediate rally in the midst of that. Go out to 2003. So this is the one I think it's a lot closer to what we're going to see for this bear market. Okay, you had your failed pullback, your failed pullback bounce, got your intermediate line up above 60. There's your first intermediate rally. Your correction, let's see, your correction will be over here. Your correction right here. Your failed correction bounce, got a cluster, got the intermediate line up. You can call this the kind of 2 pullbacks and 2 failed pullback bounces. There's your correction. There's your failed correction bounce. There's your move to and through the 200-week moving average. There's your return move, and then the bear market started from that point. I mean, from this point, from 1175 down to 764, to kind of give you an idea, after these 3 intermediate rallies, we went down to 775 from we peaked on the return move at this intermediate rally. We peaked at 1170. So we dropped 34% from here down to the low point of the bear market, right? And then the bear market ended in March of 03. So again, that kind of gives you an idea. Go back to 73, 74, all the way over into here. 73, 74, you can see the pullback, the failed pullback bounce, got the intermediate line up. Your correction, your failed correction bounce, your correction right here, your failed correction bounce, your move to and through the 200-week moving average, your return move back to the 200-week moving average at the very beginning of 74, and then the bear market, right? And you had a couple intermediate rallies, 1, 2. You had 2 there. We had 3 intermediate rallies in 2000 and 2002, right? We had, so here's the return moves. We had 1, 2, 3 intermediate rallies before the bear market ended on the 4th intermediate rally. So that's what we're facing, right? That's what we're facing right now. You know, we're probably gonna work our way down towards that 3,200 level. You know, get to and through the 200-week moving average after the failed correction bounce. We'll get another intermediate rally back up towards 3,500 again, 3,600 maybe. The intermediate line will get back above 60, get into bullish territory. We'll still be below the 200-week moving average. The return moves occur below the 200-week moving average, and then the bear market will start at that point, right? So after that third intermediate rally, that's when the bear market really kicks in gear. And we might, you know, 2007-8 had 1 intermediate rally during the bear market. 2002 had 3 intermediate rallies during the bear market after the 3 that starts it. And then 73-74 had 2 intermediate rallies during the bear market after the 3 that started it, right? So that's what we're in right now. We're in the stage of the move to and through, more than likely. But in the short term, we're going to get a move up towards the 17-day moving average, up towards maybe the 8-week moving average on the longer term chart, and probably nothing more than that, right? Looking at like the whole, you can see like, you know, we got a transition candle today, so we have an opportunity. If we close tomorrow up above that, we're going to be bullish for a while, but you see the parabolic star hasn't flipped. And if it does, you're well below the 200-week moving average. You wouldn't expect it to flip for very long. Kind of like this, but in reverse, right? In reverse to where it will flip exactly like this, where it flips to the downside for a few days, and then we reverse back and continue to leg, like I said, leg lower, most likely down towards 3,200 on the S&P. If you take a look at some of these other oscillators, like the good rally, but your positive indicators nowhere near being above 25, which is what you need to start an intermediate run. If you look at the RSI and the CCI, you're not below 30 anymore, but you're also still not above 40 yet. So you're still in bearish territory at the very low end of neutral territory there on the RSI. But you have to get above 150, easily get above 100. So, you know, 150 or higher. You have to get above 60 at the very least. I mean, you have to get above 70 to really start a new bullish run. You know, we're nowhere near that. Looking at the Ichimoku cloud, we're still way below both the green and the blue lines, much less the cloud. So, and you got a mature bearish trend that hasn't changed with this rally. So you can see it's a great move today. You're out from below the lower band. You are not, I believe, below. You're just barely above the Keltner channel. But you're still actually in the lower quartile, right? And you're probably going to get up here, get above the midpoint, get up into the upper quartile. Now we're talking about things changing around. But as long as we just rally up to the midpoint and stop, maybe a little bit above it, but avoid getting significantly into the upper half. Same thing happened over here. Same thing happened here. That's most likely what's going to happen here, where we get up to the midpoint, maybe a little bit above it, but not into the upper quartile, and then we reverse back down to the downside. That's kind of what you know, it appears to be. If you look at the volatility index, it dropped today. In fact, it dropped from being above, it opened above 105%, dropped below 100. I've shown you before in the past, that's a pretty bearish pattern for volatility when you jump above 105 and close below 100. We only had 2 days. You know, I shared this on Twitter. In 2018, like, which is a normal correction. 2018 was a normal correction here. We spent 12 days in a row above 100. 12 days in a row. In the early part of 2018, we spent 1, 2, 3, 4 days there above 100. We spent 2 days here. 1, 2, 3, 4, 5, 6, 7 days in a row there above 100 during a normal. I mean, that wasn't even a correction. That was just a deep pullback in early 2018. Going to even just this pullback in 2021, we spent 1, 2, 3, 4, 5, 6, 7 days during a normal pullback in a row above 100. This last 2 days was the first time all year that we've had 2 days in a row. And again, this is like the biggest, deepest correction that we've seen in a long time, mainly because the starting point was so high. That's why. But this is supposedly a bear market. How can we be in a bear market, right? Again, go back to 2008, to an actual bear market, right? And you can see even COVID, which some people think is a bear market. Look how many days in a row we spent above 100% there. Go back to 2008. Here's 2011 during a really pretty deep correction, the credit crisis. Look how many days in a row we spent above 100 there. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24, 25 days. And this one was at 0.998. So 25 days plus another 1, 2, 3, 4, 5, 6, 7 days in a row, plus another 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 days in a row. Like, this is the first time we've had 2 in a row all year long, and what has been the deepest correction that we've seen since 2000, because that was also a point where we started really high, and so we had a big deep correction before the bear market started. Remember, I showed you that tweet, and I talked about it in the last market outlook video, where we had 6. Let's go back to 1990 and go to a monthly chart. I shared with you before that there in 2000 to 2001 we had 6 3% down months in a row, starting with January 2001, 2, 3, 4, 5, 6 in a row before we broke the 200-week moving average, or 6, months of 3% or more to the downside. Then we had 7 during the bear market. 1, 2, 3, 4, 5, 6, 7 during the bear market, right? Well, we have 6 now. 1, 2, 3, 4, 5. Or this was 3.13. We've had this was in September 21, so this is actually this year. 1, 2, 3, 4, 5, 6 this year. We've had 6, 3%, and we're still above the 200-week moving average. So again, I think the reason why it seems like a bear market is the same reason in 2000 and 2001. Why we had 6 then, before the bear market started. Because we started so far above the 200-week moving average, right? When you start so far above the 200-week moving average, sorry. When you start so far above the 200-week moving average, it's going to take, and this is where we're at, 45%. Again, that last time we were this high above the 200-week moving average was 1999, right? It's going to take a big move just to get you to 0. It's going to take 6 months of 3% losses or more just to get you back down here. It's going to take 6 months of 3% losses or more just to get this from 45% above to 0. Bear markets don't start until you're below 0. That's how it is, right? Bear markets don't start until you are below. I mean, it's pretty darn obvious to see where the bear markets are on this chart. Even my little 5th grader can figure this out. There's a bear market, none of these are. There's a bear market, none of those are, right? None of those are. That's a bear market, there's a bear market. This is about as weak of a bear market as you possibly got, because when it started, the CAPE ratio was pretty much already single digits. It was just barely double digits. And then, so all these others, the CAPE ratios were much, much higher, like it was now. The CAPE ratio was in the 30s. The CAPE ratio was in the 30s in 2017. and we still went up 80% from from December of 2017, when we were extremely overbought in the long term. CAPE ratio was at 33, and we still rallied 80% over the next 4 years, on top of what was already an extremely overbought condition. We had that peak in 18, we had the peak in fall of 18, we had the peak pre-COVID, and then we've had the peak this year. And we just keep getting progressively more and more extremely overbought, and now you get to 45% above the 200-week moving average as a result. So as you can see, it was a higher high and a higher low. We did close above yesterday's high, so we are in a short-term rally. This near-term line is going to move up. I expect it will probably last, someone asked me today in class, I think it'll be about 5 to 7 days trading session. So through the end of this week, into the beginning of next week, we'll continue to grind towards at least this 385, probably 380 to 390 in this area. It'll be hard to push through 400. I mean, there's a runaway gap up here. If you fill that in, then we're not, then this is just a correction still, and we are still just, we could very well get to new highs by probably by the beginning of next year. That would be a possibility. It would be the longest correction, because remember, corrections resolve themselves within months. It's been, by the end of the year, it'll be full 12 months of a correction. That's very long. It's typically 6 to 8 months. So we were kind of working in that time frame there. I don't think that's the case. So I think we'll probably get towards 385, plus or minus a few bucks, on this current near-term rally, towards those really long-term resistance levels, and then fail there. All right, now let's talk about what's driving the market today. Of course, the big driver is the Bank of England starting QE, which is so crazy. But the Bank of England starting QE has brought bond yields down everywhere, including here in the U.S. In fact, the 10-year yield was pretty much right at 4% yesterday at the high. In fact, that's where we closed. We're down to 30. We dropped 26 basis points today. So we're down to 3.7%, off of that. So in a round trip from high to low, a round trip of about 30 basis points in one single day, thanks to the Bank of England starting quantitative easing. Of course, the Bank of England started quantitative easing during a time where the fiscal government is cutting taxes, in a time of spiking inflation levels, much worse there than here. Because mainly, one big reason is because the dollar is so strong, it's making their currency so weak. So, you're just throwing gasoline on the fire. I don't think this QE program, I think it's only supposed to last a month. I think by the end of the month, they're going to be way done with that. And so I think I'll probably get a little temporary reprieve in the markets because of that. But obviously, it's not long lasting. I think a lot of people think the Fed will start QE too. The Fed will follow suit. That's not how things work. That's not how it works. The Bank of England usually follows suit from the Fed, not the other way around. So yeah, this was. Talk about policy error. If you think the Fed's got policy error, then that's a pretty dramatic policy error. But I don't know why they're doing. But I think the problem is the tax cuts in a rising inflationary environment. You're supposed to take money out of the system, not keep money in the system. And so when you're in an inflationary environment, and so that's, so they're dealing with all that over there. That's one of the reasons why the pound is getting hammered, or has been getting hammered. The dollar, look at the dollar, finally dropped today too. Again, it went parabolic. So when moves go parabolic, someone said that they can go parabolic. I saw this quote on Twitter. Things can go parabolic for longer than you can think. But when they consolidate, they don't go sideways. They consolidate back down. But the continuation of that quote, which apparently doesn't fit the amount of characters in a tweet, is that you typically retest that parabolic high point just in a lot slower pace. So I think the dollar will eventually get back to this point after retesting it at a much slower pace, versus the initial parabolic move. So that's the issue, and I think that you set the peak here on this parabolic move, and the parabolic peak on yields, I think, will come down, and then we'll just kind of stick around here while the rest of the short-term curve gets up towards 4% too. Because the Fed's going to be at 4%. The Fed funds is going to be at 4%, most likely at 60% odds. The Fed will be at 4% in the next meeting, November, right before the election, right, midterm election. So the early part of November. So this is just going to kind of hang out there until we get to that point. So that's the main driver of what I mean. Obviously, remember, we are in a parabolic situation and we are in an extremely oversold technical environment. So of course, I mean, the market just latched on to anything. If you're a Harry Potter fan, it's, you know, the first movie, Harry Potter, this Voldemort evil character, spirit, whatever you call it, latched on to anything it could find. I mean, that's what happened. We were in an extremely oversold technical environment, and the markets, the bulls, latched on to the first thing they could find, and that was this headline out of England that they were, you know, quantitative easing. However unrealistic and you know, that headline seems to be, right, and definitely is not a persistent. In fact, on TV today, someone said that, hey, like, the Fed's going to raise rates. The bear market will last until the Fed's done raising rates. That's not how it works, right? Bear markets don't start until the Fed's done raising rates. Like, the Fed stopped raising rates in 2006. The bear market didn't even start until 2008, right? The Fed stopped raising rates in 2000. The bear market didn't start until 2001, right? The bear markets start after the Fed's done raising rates. The bear market starts after the yield curve moves up. So remember, the bear market started in June of 08. The yield spread was already 185 basis points. It started over here in about June of 01. It was already at 173 basis points, positive. So you go back, it doesn't go back to the 70s here. But even in the 90s, when you had that really deep correction after an inverted yield curve, by the time the correction started, you know, through most of the correction, the yield spread was rising. The yield spread hasn't started to rise yet. Bear markets start after the Fed's done raising rates. Bear markets start after the yield spread has already spiked higher. The bear markets don't start with inverted yield curves. Inverted yield curves are leading. They're leading. They have a lead time to when bear markets start. And so, you know, it's pretty naive and amateur for them to think that the bear market will last until the Fed's done raising rates, because that's literally never happened in the past. All right, let's take a look at how the sectors performed today. So let's come down here to the sector moves and take a look at what rallied here today during this risk on day, so to speak. September 28th, and we'll go to 2 minutes. Risk on day, energy did well, communication services did well, discretionary, your biggest driver, the biggest weighting in the entire S&P 500, lagged behind with staples and utilities. Of course, Apple was a big function of that, right? Apple has a big deal with XLK. It's the biggest, by far the biggest weighting in the sector, and it lagged behind. Remember, Apple has not even started to correct. Apple had a pullback. If I go to the 5-year chart, the weekly chart here. Jeez Louise. There we go. It had a pullback earlier this year, so it dipped its toe under the 50-week, had a failed pullback bounce, got it actually above the 30-week, and then now you can see, again, a correction gets you to the 200-week. That didn't get you to 200-week. So a correction gets you to the 200-week, like it did in 2018, the last normal correction we had. Even in COVID, that's why I think COVID, as from a market perspective, was just a pullback, just a very deep one, because Apple just was a pullback. COVID was just a pullback, just to the 50-week, and then it rallied. It got back to new highs within months. That's what corrections do. They get back to new highs within months. So we haven't even started to correct. See, this got back to these highs within weeks. This is a pullback, right? So once Apple corrects, if and when it does correct, you can see there's no volume here. We've rallied so much. There's no volume up here. You know, there's no volume up here. So if we were to get to the 200-week moving average, like even just from, even if you were just to draw a long-term Fibonacci from its last correction, right? Then, I mean, you can see getting down to 94 would be 62% retracement, much less getting down to like $67, where there's just literally no volume in these areas. It's going to be very easy for a company like Apple, once it starts to correct. And if and when it does start to correct, because of how big of a weighting it is, it will more than likely start the bear market for the rest of the market. More than likely, it will start that bear market there. All right, so for our trade idea of the day, I wanted to take a look at Uber. So Uber's got a nice looking chart. Obviously, it's been on a bullish intermediate run, lasted a lot longer than the rest of the market has. It's just barely starting to turn dark pink shading in a red line. It's just barely starting to turn on the weekly chart, right? You got a bearish candle here. After it's been in light pink shading for a lot longer than the market, but you've had a good rally here that lasted a lot longer. And now you're starting to roll over. Bearish candle back below, red arrow back below the 10-week moving average. PPO got up, now it's starting to roll down. You look at like some of these other oscillators. You're back below all these moving averages, including the 50-day moving average, after already being below the 200. If you look at the weekly version of this, you've got up to the 50-week. You failed at the point of control. It's rolling back down. But the nice thing is, going back to the daily chart, is you've got two volume nodes. You got a really significant volume node up here. You got a pretty significant volume node down here. So, and you've got this gap that you can fill in between, that it can just kind of trade between the 200-day moving average and the bottom of this gap down at the bottom, that it can just trade in with a relatively low bandwidth. If you look at the Bollinger bandwidth here, it's a relatively low bandwidth. So you're not in the lower quartile anymore. So what I'd like to do in that type of situation is I'd like to take a look at an iron condor spread. So selling the low 20 deltas, buying 2 strikes away, sell the low 20 deltas, buy 2 strikes away. So it gives you this this iron condor setup with pretty decent probabilities, pretty decent normal risk, because I don't have to worry about earnings till after October expiration. Good return, $434. That's what I'm willing to lose out of that $1,000. I'm willing to lose $434, and you can see those break evens are sitting right there on the chart, right where those volume nodes are. You can see it here as well, right where those volume nodes are, and it's well within the point and at the gap, at the bottom of the gap. So I really like, as long as we stay within these support and resistance levels, we get a good return. After a pretty volatile bandwidth, now your bandwidth is a lot smaller, and it looks like it may be peaking itself now that you're not in the lowest quartile anymore. It may be peaking and rolling over from this level, kind of like over here, and you just kind of consolidate into expiration. If that's the case, we can get a pretty decent return for the risk that we're taking on this trade. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link that's popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have. Reply to anybody else's thread. And let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Like us on Twitter and Facebook as well. Join our website at marketscholars.com. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.